Krishna. Jai Shri Krishna and a very good morning to everyone. On behalf of Team Drshtikon, this is Urmi Kanani welcoming you all to the 36th webinar of Drshtikon Talks. At Drshtikon Talks, we bring you eminent Bhartiya speakers and experts to share the knowledge and valuable experiences during the course of a live webinar. For the webinar to be conducted smoothly, we request you to kindly disable your audio and video and post your questions in the chat box to be taken up by the moderator. I would like to start my today's session with a very famous quote by Peter Lynch. Know what you own and know why you own it. A wise holding today may not be a wise holding in the future. So, to reevaluate your portfolio on a timely basis, we bring to you all the stock market veteran, Mr. Hiren, co-founder and chief investment officer of Alchemy Capital Management with over 31 years of equity market experience. Mr. Hiren has been an equity market specialist for over 3 decades and has built an enviable record of beating the market returns consistently. Immediately after his graduation, he joined KR Choksey on the sell side and later on joined Prime Securities to gain the buy side knowledge. Post this exposure, he founded Alchemy Capital in 1999 to spearhead the firm's asset management business along with his co-founders Rashid Sanghvi, Ashwin Kedia, Ashish Kacholia and Rakesh Junjunwala, and has built a long-term track record. Alchemy Capital has a very stable and experienced team of investment professionals with experience in managing funds through bull and bear cycles. Hiren is also an avid reader, runs marathon, and is a wildlife buff. In today's session, we are going to have a fireside chat between our moderator, Mr. Ankit Bhatia, who is a chartered accountant and company secretary by profession, having a decade plus of an experience in the investment banking industry. He is presently the Vice President of Axis Capital, the investment banking of Axis Bank, which offers investors, companies, and government entities a spectrum of financial products in the areas of equity capital markets, M&A, private equity, and institutional equities. While looking forward to this session, I welcome Hiren to Drshtikon. Over to you, Ankit Bhai.
Jai Shri Krishna, everyone, and thanks to me for the brief introduction. I'm sure the viewers today would like to have insights on many stocks, considering the returns Hiren has generated. However, as Hiren is part of SEBI-regulated entity, we request the viewers to refrain from questions on stock-specific ideas. Hiren, would you like to give the disclaimer, please?
Yeah, good morning to everybody, and thanks Drshtikon for hosting me today. It's a real pleasure and privilege, and I think this is a phenomenal job that you guys are doing in terms of sharing knowledge and ideas. Yeah, I think the disclaimer is largely because, as you know, that I'm part of a regulated entity, and all the views here should be considered my personal views and not that of my organization. And I may be talking about specific companies in today's talk more by virtue of as an example rather than take it as a recommendation or anything of that sort. But with that, I really look forward to a very enriching and interactive session. And thank you again for giving me this opportunity.
Thanks, Hiren. We all remain irrational longer than one can remain solvent. And in investing, what is comfortable, rarely profitable. Before Hiren instantly and comfortably over decades, we have a short presentation from him on the market outlook and how does one play disruption, which will also set the tone for our further discussions. Over to you, Hiren.
Thanks, Ankit. Let me just share a screen. Are you able to see that, Ankit?
Yes.
Okay. So what I'm planning to do is that over the next maybe just 15 odd minutes, talk in general about the markets, discuss a few concepts that I think are relevant And then I would rather have more more of the time spent on the fire chat and then Q&A, because I think that would be much more useful rather than me just doing a monologue on markets, right? I mean, everybody anyway has too much of CNBC in their lives. You don't want somebody just keeping on talking. So, I think that because markets fluctuate so widely and respond to any and every kind of news, right? Whether it's economics, politics, business. I've kept the heading as navigating rough seas of the markets smoothly. And right before I jump into the slides, I must say that obviously the stock market, people have to be optimistic and are generally optimistic by nature. But I can say with confidence that in my 31 years that I've been in the markets, it is my very strong belief that the next 10, 15 years belong to India. And I think while we will talk about the risks in investing, but I think the biggest risk is not investing in India when India's golden period over the next 10, 15, 20 years is just about beginning, right? And not for any other reason, but if you really look at it, we all know that, India is, and even next year will continue to be one of the fastest growing economies in the world. And why this is important is because equity as an asset class, right, is a slave of earnings growth. So if the economy grows and companies grow and their revenues and cash flows grow, market cap has to grow. And I think that India cannot be ignored anymore amongst the nations in the world, as we have now reached a scale and size where if we start to grow at 7, 8, and some people believe even at 10% at some point in time, I think India as a country cannot be ignored. We will be one of the fastest growing economies in the world. The other big advantage that India has got is that we have the largest young population, which is commonly called as demographics, right? We will be the youngest country on this planet between now and well into the mid 2030s. And when you have a large part of your population, almost 60% plus of your population between the age of 18 to 35, it does a few things to your country, right? Because this young population is very productive. They earn, they save, they spend, they invest, they consume, and that is all that drives economic activity, right? As if economy gets more and more aged, right, and the dependency ratio goes up, which means that you have more older people than younger people in your population, the cost to the economy go up because there are less working people, but you still have to take care of these people in terms of their pension, healthcare benefits, and so on and so forth. So to put it very simply in an accounting language, right, the liabilities of a nation increase as the nation gets older, and the earnings power of a nation improves dramatically when the nation is young, because people are earning and saving and increasing economic activity. I'll specifically talk a minute or so on this slide, right? So this is the GDP per capita. And what it means is that if you divide the total GDP by the total population, you get the per capita GDP. And historically, if you look at any nation that has gone from being a developing to a developed nation, right, there comes a inflection point in its history that whenever the per capita income crosses somewhere between $1,500 to $2,000, you see a massive acceleration that happens thereafter, right? And every country, so, you know, a lot of these countries were called the Asian tigers: Thailand, Indonesia, South Korea, China. And now I think it is India's turn. So if you look at this chart, China, the per capita income crossed that $1,500 mark sometime in 2003-4. And thereafter, you see the acceleration from 2004 to date, right? They have already crossed a per capita of $10,000. It's now a rich country, right? I mean, somebody like, some country like US, which has a population of 350 million people, is at about $50,000. Or some of the Arab countries may be at $60,000. It's going to be impossible for a 1 billion plus country to reach that level. But $10,000 for 1.2 billion people is a lot of money. And I think something very similar is likely to happen in India over the next 10, 15, 20 years, because once we cross that $1,500, $2,000 per capita, we have more money, which, initially when you are a poor country, you are largely spending on food, shelter, right? The basics. But once you start having extra over and above to take care of your necessities, then you start buying newer houses, you start buying cars, you start buying gadgets, you start going on holidays, right? And that creates a massive boom. And I think India has crossed that per capita $1,500 in FY10. And now this year, I think we've crossed about $2,000. So I think the next 10 years are going to be very, very exciting for India. And you will see almost like a hockey stick growth in consumption. So let me give you just one statistic, right? And it is so uncanny that in 2002-3, when China was at $1,500 per capita, they used to sell about 3 million cars, right? 30 lakh cars a year. And today at $10,000, which is about 5x, it's a 20 to 21 million car are sold in China, right? So it went up almost 10x than where they were. And if you look at India today, we sell about 3 million cars a year at $1,500 to $2,000 per capita. You can imagine in the next 10 years, well, they may well be all electric vehicles, but that's the kind of growth that you see once you move to that, you cross that magic $1,500 to $2,000 per capita. Now, if you see this, and I don't want to be very technical, but if you just look at the left-hand graph, why I'm so bullish about the next few years is because, earnings are cyclical, right? And we've plotted this from 94, 95. What we've done is that you add up all the corporate profits, every single company which is generating or not generating money, you add up everything and you take it as a percentage of GDP. And you will see that we went from almost 4% in 94, 95 down to 1.9 to 2% during the tech bust. And then that ratio went up almost 3 times to 7% of GDP. The profits increased. And this was the time when we had the best bull market, right? If you guys remember, between 2003 to 2007-8, we had a roaring bull market. And that was because corporate profits were rising and growing at 20-25% a year, more than 25% a year, right? And from there, India has almost witnessed a earnings recession, right? We fell during the global financial crisis. We again rose to about 5.8%. But from there, it was a one-way downhill journey. And usually we bottom out at somewhere between 1.5 to 1.7%. And then we start reviving again. And therefore, my view is that if you look at the right-hand side box, right, if you assume that our GDP grows at 12% in nominal terms, and I've taken very conservative numbers, 6% real growth and 6% inflation, you add that up, you get about 12%. And if corporate profits to GDP go from 2.6, I'm not even taking a peak that we had reached of 7%, but even if you go to 4.5%, 5%, annually profits will grow about 20% in this country, 25% CAGR, right? And that is why, despite whatever is happening in the markets today, I'm very, very confident that we are starting a new earnings growth cycle in India. And as they say, that stock prices are a slave of earnings. So we believe that we are likely to see a massive rebound in earnings growth over the next couple of years. There are always some hiccups that may come in between, but I think the trend is very clear. I think we bottomed out, and in a year which we least expected, which was the COVID year 2021, earnings actually went up. We all know that, finally Indians are taking on to equities as an asset class, right? And we have seen that, the dark golden bar is FII buying or selling. And if you look at the gray bar, that is the domestic investors' volumes, right? And if you see very clearly that Indian investors are now playing a much more significant role in the equity market than the FIIs are. And we have seen this trend with the kind of SIP flows in mutual funds. We are almost now 12,000 crores of SIPs every month, and equity AUMs continue to grow. And I think gone are those days when, we would be glued on to the TV trying to figure out what the FII is going to do and, feel good or bad about the fact that they are either putting in or taking money out. And I think it's important. I mean, I'm not belittling the fact that we need foreign investment, but my simple point is that today India's pool of savings is significantly large, that it can dwarf FII investments in this country, right? The highest that FIIs have invested any time in a year is about somewhere in the region of 17, 18 billion dollars. But if you do the math today, right, India generates close to $900 billion of savings every year. And hardly 5% of that goes into the equity markets. But even if I take 5% of $900 billion, right, that is $45 billion. That is 3x of what the foreigners put in this country. So I think to that extent, India and the Indian equity markets have become Atmanirbhar, right? The other reason why I'm very, very bullish about India is that, you need more and more people to get into business and start taking risks. You can't just have the Tatas and the Ambanis and the Birlas getting into every business. You need fresh blood. You need fresh entrepreneurship. I was going through the video of Harsh Mariwala, right? I mean, he built an iconic company, Marico. Just when we had phenomenal MNC companies like Levers and Colgate and the Nestle's of the world. But, Indians did create their own world-class consumer company. And I think that is now increasingly happening, that there are more than 100 unicorns in this country. There are 50, 60,000 startups in this country. And the risk capital is today available in abundance. There are billions of dollars which are going into venture capital and private equity, where these entrepreneurs are getting a chance to make their dreams into a reality. And this is very important. I mean, the reasons why, very well-to-do Indians used to go out of India was because those countries gave them an opportunity. There was no bureaucracy and there was risk capital available. and Indians flourished all over the world. And US is a classic country. Every major tech company CEO by and large is Indian, whether it's IBM, whether it is Alphabet, right? And more Indians are going at the top. And I think we don't have to now necessarily go to Silicon Valley or to the US to fulfill our dreams. I think that is happening very close to within our country. I think India has started to build that virtuous ecosystem where there is people who are willing to take risk, bet on young businesses. And I think we are going to see this increasingly going to happen, right? For every Uber, there is an Ola in India. For every Amazon, there is a Flipkart, which was born in India. It's a different story that Walmart acquired it. But, I think Indians are now waking up to the power of entrepreneurship. And then just one last thought that I would want to give, because I'm sure all of you are investors one way or the other, right? That we tend, the stock market and the economy is very, very dynamic. And what works for a point in time may not necessarily work in the future. And therefore, I thought that I must put one or two slides to show that past leaders may not necessarily give the best returns in the future, right? So we all say, oh, this is a great blue chip. This is a great company. It has given me great returns in the past. If I hold on to this company, I will similarly make money in the future as well. That's like trying to say that driving a car by looking into the rear view mirror. Yes, in a car, a rear view mirror is important, but it is small. What is important when you drive a car is the windshield, what you see ahead of you, because equity returns are all about the future. It's not about the past. The past is a good guide. So what may have necessarily worked in the past may not necessarily work in the future. This is a little bit of a busy slide, but the simple point that I want to make is that, if you look at 95, right, what did the index or the Nifty constituents were, which were the sectors which had a large constituents, and every 5 or 10 years, if you look at the trend, right? So if you see 2005, financial services was only 12% of the Nifty. Now it is 37% of the Nifty, right? But if you look at energy, that has gone from 30% to now almost single digits. So what happens is that over time, as the economy changes, new sectors become a bit larger and larger part of the economy. Just like financial services or banks became almost 35% of the index. But if you look at some of the examples in the US and China, right, in 2005, the total weight of the technology and the internet sector in the S&P 500 was only 13%. That's gone up to as high as 40%. Maybe it would have peaked. But look at the kind of leadership that changes over time. Or even in China, in the China Hang Seng Index, right, technology was hardly 1% in 2005. Today, it is 24% of the index. So things keep changing. And if we don't change with the times, then, I think you will end up having suboptimal returns. And I wanted to give one example more near home. So if you look at the last 3 years, right, the bank index has given a 9% return. This is as of 31st December 2021 data. And if you look at HDFC Bank and Kotak, they have given 11 and 13% compounded returns. Now, both HDFC and Kotak were hitherto considered to be the leaders in the banking industry. But look at who has given higher returns. It's ICICI and Bajaj Finance, which have given 27 and 38% returns, far, far outstripping what the bank index has done in the last 3 years. So leadership always changes over time. And if you similarly look at one global example, right, by the end of 2014, if you added up the market cap of all the global car companies, it was about $800 billion. And Tesla was only 28 billion. And if you look at in 21, right, all other global car companies, which is the Hondas, the Toyotas, the Volkswagen, the BMWs, the GM, all the global car companies put together had moved from 800 to 1.2 trillion, but Tesla moved from 28 billion to 800 billion. In fact, at one point in time, Tesla's market cap almost reached $1 trillion. And the other new age EV companies are already at $200 billion. Now, obviously, they have all corrected. But the point I'm trying to say is that there is constant change in the environment and leadership changes. Just because you were a leader in the past does not necessarily mean that you will be the leader in the future, right? And it's a combination of industry dynamics and a lot of other changes that you see in the environment that make leadership change. And as I mentioned, that increasingly existing companies will see a lot of competition as new entrepreneurs are now getting funded. Yes, we need to be very careful whether they are great investments or not, and we will talk about this. So I don't want to take too much time now. So I'll probably stop my presentation here and I'll let Ankit move on to the next section. I hope, this was a very short overview. I know we can, I can just keep talking about every aspect of the market for hours together, but, I'll probably wait here and move to the next session.
Thanks, Hiren bhai, for an insightful presentation on the markets. Before we deep dive into the granular aspect of the markets and the new age technology companies which you highlighted, we would like to know a bit more on your personal journey in the industry and what really piqued your interest and love for the equity capital markets post your graduation.
Yeah, I think coming from a Kutchi Gujarati family, typically, right? Investing runs in the blood. And I must credit my journey in the equity markets to my dad. He came to Bombay to study. And actually, the investing started by my grandfather in the early 60s, right? That's how long our family history in equities goes. But since dad was in Mumbai, he started taking a keen interest in the equity markets. He used to go to the stock exchange. But I was a kid back then, and he would take me to some of these annual general meetings, right? These AGMs, they were like a nice mela. Sometimes you would get some small gifts. But I think that piqued my interest very early. And he used to say, keep quiet and listen to what Rahul Bajaj is saying, or listen to what Dhirubhai Ambani is saying, or listen to what H.T. Parekh is saying. And, listening to these visionary business people, and also dad used to invest in many of these MNC companies, and their annual reports used to come home. They were very colorful. And, I started reading them. And over time, I started collecting annual reports. So, during college, I would finish college and then I would once in a while go to the stock market and hang around there, right? So my interest in equity markets started very, very early. And I think one good thing for me was that I was very clear in my mind that this is the place that I want to be. This is where I want to build my career. And investing is something which is very, very fascinating. And therefore, I finished my graduation, I finished my cost accounting simultaneously, and I straight away headlong went into the equity markets when I was still 20 at that time. So, it's been a good 3+ decades in the equity markets now.
Too young age to get into the markets. But as you rightly pointed out, right, for every Gujarati, investing runs in their blood. So how challenging was it for you as an analyst to get into the markets in your initial days, especially when access to information was not as quick and as easy as it is today?
Yeah, we used to I mean, in the good old days, there was no conference calls, there was no quarterly results, right? And information was not available. I mean, you used to get the annual report once a year. And then what we used to do is that try and attend every shareholders meeting, right? So that is the only time that you would get to meet with the management of the company. So after the meeting is over, you rush up to the stage, you go and try and have a conversation with the CFO or the managing director, and you try to ask a few questions. In those days, we used to go to the stock exchange, had a library on the top floor, and we would go and collect cement data, what are the monthly sales, or there was an association of polyester fiber manufacturers just at the IMC building next to Churchgate station. And me and my friends would go there. You have to pay a small fee, they would give you a file, then you sit down and you actually either Xerox or write down all the production data, right? So research back then was very different from what it is today, right? You had to physically go to places. But the good thing is that I got a very good grounding on this when I started my work at KR Choksi and Company, and Kissanbhai is a great value investor, known back then. And he used to encourage us to go and visit every annual shareholder meeting. He used to take us for plant visits. We used to go. I must have in my life visited at least 300 to 400 companies physically, right? Going and visiting a plant. I've seen a tire plant. I've seen an automotive plant. I've seen a cement company. I mean, you can name a manufacturing business, and I would have probably visited them at some point in time in my career. Now, obviously, everything is on the web. There are transcripts available. You can, even if you are not attending the call, you can later on log in and read up a lot of stuff. So now access to information has become very, very easy. And it's no longer, in my view, a competitive advantage. Back then, 20, 30 years ago, if you had information ahead of anybody else, that was a big competitive edge, because you knew before the general janta knew, right? And access to information was not available. So yeah, I mean, we've traveled a long way since then.
Hiren, we'd be really interested to know what was your thought and vision to start up Alchemy almost 3 decades ago, and also onboard a celebrity investor like Mr. Rakesh Jhunjhunwala as a co-founder.
Well, actually, it's quite interesting. It's a very, very historic day for me today, because 8th May 2002, exactly 20 years ago, is when we actually started business. My first portfolio went live on 8th May 2002. And here we are on 8th May 2022 talking about this enterprise, right? So yeah, I mean, I think after so I joined KR Choksi in 91. I worked with them for 4 years in research. Then I worked another 4 years between 94 and 99 in prime securities. And then the entrepreneurial bug bit me. I said, it's okay. I mean, 9 years I have taken experience. I worked with other people. Now I want to work for myself, right? And when you take these career defining decisions, you sit with your best friends and buddies. And my current partners, Lashit and Ashwin, we had become friends since 91. So, we used to hang around the stock market together. We all had a common passion for investing. And in 99, when I told them that, look, I'm thinking now of branching out on my own, and they encouraged me. But a few conversations down the line, an idea came up that why don't we all get together and start a new company? And at that time, SEBI was encouraging professionals to get into the business, right? I mean, in the good old days of 30 years ago, it was the topiwalas and dhotiwalas, as they say, no offense meant in that sense. But it was not necessarily a place where professionals would go, right? Today, it's a very different thing. Today, the best of engineers and IITs want to get into finance because this is a profession which pays you so well, right? But back then, SEBI wanted to encourage CAs and MBAs and cost accountants to come to the stock market. And I saw an opening, and I thought that as India's equity markets mature, there will be a need for people to professionally manage money for others. Because otherwise it was typically, there were very few institutions. There were mutual funds which started in 91, 92 and that time, but it was still a very, very young concept. And we had a passion, and, we thought that we should set up a professionally run company built on ethics and great insight and understanding, and manage other people's money in the equity markets and deepen the equity cult in this country. Rakeshji was earlier a client of ours, even before we formed Alchemy, right? And the visionary that he is, he was always bullish on India. He's been so bullish on India for the many, many years. And he likes to back young entrepreneurs. And it was in 96, 97 that he encouraged my partners, Lashit and Ashwin, to organize themselves into a proper company. He agreed to become a partner in the firm with no other expectations. And he had very, just two simple conditions. He said that, one, I will not run the firm on the day-to-day basis. That's your job. Like, you guys will run it. I'm just a silent partner. But my doors are open. If you need any guidance, you need any help, I will be more like a mentor. And he's been more like a mentor to us, friend, philosopher, guide. We've learned a lot from him. And the second thing he said, that don't do anything which will make us look down, right? So run your business very ethically. And I think on those foundations of being absolutely fearless, very independent, we started Alchemy Capital. And I think today, on day one, 20 years ago, I remember I started with 5 crores and 7 clients. And today we have more than 4,000 clients, and we are managing more than 7,000 crores in assets. Right? So it's been a great journey, a very, very fulfilling journey. But all I can say is we are just getting started. There's a lot more to go.
As there's a saying, things are never scary when you have the best of friends with you. And many congratulations on completing 20 years. But most of us here, Hiren bhai, would be keen to understand your investing style and how has that changed over the last 20 years, considering a substantial shift in the regulatory environment in India, and also how the sector themes have evolved from the traditional industrial space to the Zomatos and Nykas of today.
Yeah, so, a very good question. People have asked me, how has your investing style evolved, right? In one way, I was lucky that, all the early people who mentored me, whether it was my dad or, Kisan Bhai at KR Choksi, they were all very long-term investors. And they used to always say that, think in terms of 10 years and 15 years and 20 years, not 1 year and 2 years. This is not a game. This is not a T20 match. This is a test match, right? So I think some of these fundamentals were indoctrinated into me very early, but still, you are young back then, and you feel that there is no fun in trying to research a Reliance or an HDFC Bank or, the blue chips of that time, right? Because those are so well known to everybody. There is no fun in doing that. So you want to find that very small unknown company which you think will go up 10x, 20x, 30x, right? So to use a cricketing parlance, you want to hit every ball out of the park as a 6. But unfortunately, that's not how the game of cricket goes, right? If you try to hit every ball out for a 6, you might very well get out very soon. And then soon I realized that, you can't predict multi-baggers, and you can't build a portfolio or invest by thinking that every company is going to be a big winner for you, right? Because you have found it, because it is under researched. And you realize that there is a value in size, predictability, scalability, right? That big companies can also compound and give you lots and lots of wealth, and then amongst 10, 15, 40, 50 companies, you will come across maybe 2 or 3, which turn out to be huge multi-baggers, but you never know them on day one, right? If you know them on day one, I think you are crediting yourself with too much of intelligence, because it's only with time and circumstances do you know which companies really do phenomenally well. I mean, look at the kind of multi-bagger Titan has been for Mr. Jhunjhunwala, right? I mean, but just imagine how many years did he sit on that stock? It's been now more than 25 years that he's been invested in the company, right? And not every company is a Titan, nor is every company a Bajaj Finance. And I was lucky that in my career, I could find my first 125 bagger, right? We invested in Bajaj Finance in 2010, and today it's 12 years and it's been 125x. But I can't expect every company to be a Bajaj Finance. So I think we matured as we grew, and the markets taught us that they are more supreme than anybody else, and that emotional quotient is more important than IQ in this business. So if you think you're too smart, the market will cut you down to size, right? And it's very exciting to invest in small and mid caps, but it is very few make it. And we did this exercise, I think about 12, 13 years ago. We looked at 1,400 companies which were considered as small and mid caps, let's say in 2009. And we said, if we give them 10 years, how many of them really graduated to becoming large caps? And only 3% of 1,400 companies graduated to becoming large caps. The rest never made it, right? They struggled. And therefore, while it is very exciting, it's not that easy. If it was that easy, everybody could have done it, right? So I think, giving, not just thinking about growth and small companies trying to grow faster, but thinking about how big is the opportunity, how sustainable is the business, whether the management has the depth and the capability to professionalize, right? I mean, Harshbhai wouldn't have been able to build Marico if he didn't bring in professionals, if he did not deepen the bench. And I think, therefore, there is a very interesting book, Crossing the Chasm, which tells you that very few companies are able to cross. Every 10 years, they are able to progress. And even in India, right, there are very, very few companies which have shown that year after year after year, or decade after decade, they are able to reform and progress. So one very interesting statistic is that, 10 years ago, the Nifty, as you know, has 50 companies, right? And only 17 out of those 50 companies are today there in the Nifty. 35 have not been able to be part of the Nifty. They're completely new companies that have come into Nifty. So I'm not surprised that from the time when, Mafatlal and Century and, those were the Bombay Dines were the blue chips. And many of these blue chips are no longer there. Orke, right? I mean, they were filled with textile companies and metal companies and, but very few metal companies have survived, right? Probably only Hindalco and Tisco are still in the Nifty or the Sensex. I think Reliance stands out in terms of how every few years they've been able to move from one business to another, right? They started as a textile company, moved into petrochemicals, moved into refining, then moved into oil and gas, then telecom, then retail, now green energy, right? But it requires phenomenal vision and execution to keep adapting. And therefore, I think, and that's why I showed those slides, right? How sectors have changed. We've moved from traditional industries in manufacturing to more services, like banking was the biggest services. It became the largest part of the Nifty today at 35, 36%. But 10 years down the line, it could be many other businesses, right? Largely internet driven businesses, very different kind of businesses. As India changes, different industries will become bigger.
And while you briefly touched upon the market outlook for India and continuing from there on, we were at an all-time high in the month of January. But at that point in time, we had never envisaged a war, a spike in crude prices, inflation was supposed to be transitory, and world had not seen an energy shock. Despite so many external and internal factors, markets haven't corrected significantly, and we don't seem to be entering into a bear market anytime soon. Are you really surprised with the resilience Indian markets have displayed? And how do you foresee the markets pan out over the next couple of months? Does the trend actually suggest that we are on a multi-decade bull run?
So, Ankit, I have no doubt that we are in a multi-decade bull run. And the bull run that we will have over the next, I can't say for sure what's going to happen in the next few months. My reckoning is that the next few months are going to be challenging for the markets because, we are generally seeing, rising interest rates, inflation, oil prices, the war still continues. Not that we will get into a very severe bear market. I don't think we're going to get there. But I think the markets, after a phenomenal rise from the COVID lows, right? So typically, if you look at the anatomy of any bull market, right, what happens is that from the absolute crisis lows, you have a massive run. Just like even in 2008, when the markets fell so dramatically, where the index went down from the Sensex went down from 21,000 to almost 7,500. But within 2 or 3 quarters, it rebounded back to 15, 16,000. But then we spent a good 5-6 years in that range of 15 to 20,000. We kept on bouncing around, right? So markets has this habit that when we go into a sharp downturn, you have a big recovery, and then the market may go into a consolidation phase for some time. It's like when you sprint very hard, you have to pause and take breath. I think the market sprinted very hard, where the Nifty was down to 7,500. And from there, we went up almost to 18,000, right? And now we are catching breath. So I don't think we are in a bear market, but I think we are in a sideways market for the next few months. But having said that, for the reasons that I elucidated, right? I mean, India has shown amazing strength in the face of such adversity. My sense is that the market is very smart. It is sensing that there is a big earnings growth recovery in this country, right? Last few years were very tough for us. It all started with the IL&FS crisis, then Yes Bank, and crisis after crisis. Then we had the GST implementation. Then we had COVID, right? I mean, the corporate sector has gone through such massive crunch time in the last few years. And as I showed, that profitability got massively squeezed for the last few years. But now industry has consolidated, right? So the unorganized players are falling by the wayside. The organized players are, increasing market share. And we can see that in the GST numbers, right? We had record GST numbers. So, we've gone through a very tough phase. India Inc. has completely deleveraged, from the previous levels. So I think the market, in many senses, there are 2 or 3 reasons why I think it is so resilient. One, as I mentioned, that there is more of domestic savings that is driving equities in this country, right? Finally, not just a few Kachis and Gujaratis and Marwadis have, who were always traditional investors in equities. There is all of India, which is now investing, the nook and corner of this country. And I think to that extent, the mutual fund industry did a brilliant job of marketing itself. Mutual fund sahi hai, and the concept of systematically investing every month, SIPs, right? Where we've now reached 12,000 crores of SIPs every month. So finally we are seeing a lot of the domestic savings, which used to traditionally go into real estate or fixed income or gold, now move into equities. And it's a structural shift in my view, right? So that is one. Second, I think that the market is sensing that we are cyclically going to see huge growth in earnings over the next few years, right? And I think, as I said, India's time has come. In my view, I could be wrong, as everybody has a right to be wrong, but in my 31 years, I've never been as bullish on India as we are today. I think even geostrategically, we are so nicely, positioned. I think that the China plus one strategy, what this government is doing, I think, and more importantly, forget everything else. India has always grown despite the government. I think India's entrepreneurship and availability of risk capital, right? And now, I mean, I think that there is nothing stopping us. So yes, there will be an occasional very bad phase in the markets, but that's the nature of markets. But I have no doubt that if we can navigate the next few months, which may be very tough and volatile, I think a bull market like we've never seen in our lifetimes is awaiting us.
Good to hear from you that. We have a question from Amit Ved. His point is, as you rightly pointed out, there has been significant money flowing in from the domestics through SIPs, and approximately 5% of Indian population is yet invested in the market. So do you see this trend increasing wherein the domestic retail investors would fund the markets, or it would be driven by FIIs going forward again, or would it be a combination of both?
Oh, I think it will be a combination, right? I mean, I think, as I said, that as India grows and goes from a $2.5 trillion economy to eventually a 5 and then a $10 trillion economy, right? You cannot ignore India, right? And therefore, ultimately, at some point in time, the foreigners will come back. My personal reason, so typically what happens is that when global interest rates go up, right, typically emerging markets don't get flows. And that is what is happening. And but I think maybe in a few months' time, a few quarters down the line, I think this trend of negative FII investments will reverse. And in India, as I said, you look at the number of new demat accounts that have been opened, look at the amount of participation that we are seeing, whether in mutual funds or directly, and this is only going to increase. This $30-40 billion is nothing. A time will come when $200 billion of domestic savings will go into the equity markets in India. Because if you look at the Asian average, it is more like 10-12%. I'm not even talking about how much of savings in a typical US economy, almost 30-40% of the savings either through your 401k accounts or whatever go into the equity markets, right? And in India, the pensions have just about started to invest in equities, right? So I think we have a long way to go. And my firm belief is that the Indian stock markets will be driven by Indian savings, not as much as global savings. So I think finally India has turned the corner. We are Atmanirbhar in supporting our own equity markets.
Fully appreciate, and agree with your points. But if you see historically, India has seen multiple cycles of specific sectors like real estate, metals, specialty chemicals, and now the EVs playing out in each of the bull runs. So how should one play with the cycles and identify the multi-baggers early on? Well, you've touched upon it, but as there's a saying, stock markets value companies that can deliver disruptive innovation.
Yeah, I think, So there are a couple of ways that you can play this disruption, right? A lot of investors understand this when they read and they see the kind of market caps that have been created by companies like Google, Alphabet. I mean, both are the same. Apple, Tesla, right? And they say, how do we play this theme in India, right? Now, you have to be very careful when you want to play electric vehicles. Like, so let me again share a few charts, right? And so there are direct plays, but there are also indirect plays that you can have. Can you see the chart?
Yes, it's visible.
Okay. And I will jump straight into, so, let's say if you don't have to necessarily only invest in new age companies. Like, let's take the example of Titan, right? Now, many years now, Titan is obviously a great jewelry, great brand company. They were iconic. They created iconic brands like Titan, Tanishq, but they were also ahead of the curve. They understood that the future of jewelry retailing at some point in time, it will also get onto the internet, right? And they invested in a company called Carrot Lane, which is a pure online. They do have some offline stores, but it's a pure online jewelry retailer, right? And they do small, occasion jewelry, which they sell on the internet, which is where the youngsters want to buy, right? And they took a stake, and now they own a majority stake in Carrot Lane. But look at the kind of growth, right? From 98 crores to almost 1300 crores. And this business really accelerated during COVID. So you can see that in 2021, it was around 600 and 700 crores. And suddenly sales almost doubled, right? And they are now growing at 1400. They're almost compounding at 40-50% a year. So there are several ways that you can play the new economy by looking at some of the existing companies which have either made investments or are moving into some of these new businesses. I gave an example of Reliance, right? What they've done with Jio, and now the way they've aggressively moved into new energy. Another example of this is Saregama. Saregama was that old HMV company, right? And they had, their value was that they had music rights to a huge amount of songs. Now, unfortunately, you would know that music streaming has boomed around the world. We all listen to music on Ghana or Hangama or, Spotify, Amazon Music. There are a lot of these streaming services which have started, which stream music. And there has been an explosion, YouTube Music, right? Now, Saregama is a great way to play the boom in digital streaming of music, because every time you download or you play a song on YouTube or Ghana, the owner of that rights to the music gets a royalty, right? Now, sitting in India, I can't possibly invest in Spotify. There is no pure play, OTT play, as they say in India so far. But a smart way to gain, because of the explosion in digital distribution of music and videos, was to invest in Saregama, right? So even if people are making a TikTok video or whichever video, and there is a song playing at the background, you have to pay that little royalty to the people who own the rights to the music. Again, don't take this as a recommendation, but this is more like, trying to give an example. Now, obviously, Nykaa is somebody which is like a pure play on the new age, right? they've consolidated the entire beauty industry on a lovely platform, right? So you go on Nykaa and you get the best of premium brands, normal price brands. And just imagine, I mean, Lakme has been around for so many years, but look at what a platform has done, right? So if you look at some of these businesses, they are likely to grow at 30-40% a year, which is almost 2x to 3x of what your nominal GDP is growing, right? Now, obviously, you have to be very careful at the valuations at which you want to invest. And I think one of the classical mistakes that most of these startup companies are doing when they are going public is that they don't want to leave any money on the table for the investors. And therefore, investors have to be, while these are all companies of the future, these are the kind of companies which will become a larger and larger part of the market cap going forward. But at what valuations you invest in them is very important. For example, we invested in a software company called Tata Alchemy, right? Which is a big beneficiary of electric vehicle trend that you spoke about, Ankit, right? I mean, if you look at this, if all the global car companies in calendar 20 were spending $20 billion on R&D on electric vehicles. Now, by 25, that spending will go up to $60 billion. Every global car company has to spend on electrification to compete with the likes of Tesla, right? And the market is very smart. And therefore, now in India, I can't be buying Tesla. Now, obviously, there is, the Indian government does allow $250,000 per person per family to be invested outside. And today, some of the mutual funds and online brokers give you access to buying foreign equities. But largely being an Indian investor, being in India, there are indirect ways of playing some of these themes like electric vehicles, right? There are very few pure play EV guys today in India. So one way that we were wanting to play the global EV theme was to invest in software companies which develop software for these automotive companies. So the likes of Tata Elxsi or a KPIT or an L&T Technology Services are at the cutting edge of developing software. And you can see that, while the IT index has compounded at 40% for 3 years, some of these companies have compounded at much higher rates, right? Because, that was because they are growing much faster because the opportunity is much bigger for them. So to answer your question, there are several ways to play disruption. If you can research and understand some of the existing companies which are listed already are doing very creative things. Like I said, to play EV, we played it through software companies in India. To play the explosion in digital distribution, one way to play it was to invest in a Saregama, right? Or you will obviously have direct companies which will be available for you to play as they list. But then you have to be extremely careful at the valuation at which you want to invest into these companies.
Really appreciate it. But moving on to the core topic of discussion for today, the new age tech companies. We've seen a lot of excitement in the market for these companies, which also have seen a roller coaster ride after taking the plunge into the public markets. Approximately 40 to 50,000 crores have been raised by these new age companies in the last fiscal. Do you believe demonstrating a path to profitability before they approach the public markets is a must for these companies? And how would you recommend the investors to play in this sector?
So you're right, Ankit, that, it is all great when these companies are raising money privately, where, round after round, their valuation keeps going up, right? And these companies are still unprofitable. But once, listed investors or listed markets are very clear, they want a clear path to profitability and cash flows, right? So it's not that investors don't understand if you are temporarily losing money to gain scale uh, and competitive edge. But I think the kind of valuations at which some of these companies came to the markets were clearly unsustainable. And I think the key to investing, so what I would recommend is that even if you want to invest in many of these new age companies, which may not be profitable, and therefore, Nykaa stands out because they are a profitable business, right? They've at least demonstrated that they have one stream of revenue which is profitable. So they started with the beauty business. They are profitable, which means that they have shown that the model works. Now they are doing new things, right? So after beauty, they said, okay, we will do a similar thing with fashion. So I'm going to add another revenue stream to my existing platform. And then tomorrow I will do home furnishings. They've also started to sell, home furnishings and, a lot of other things onto their platform. But at least the core, which is beauty, was profitable, right? So I think when you evaluate a business, so let's take an example of Paytm, right? So Paytm is a payments business. UPI has boomed in this country. But unfortunately, payments as a business does not make money because UPI killed payments, right? Because you could zip money from one person to another or from a merchant to yourself through UPI and not pay a penny in between as transaction charges. So payments is not a profitable business. So now what is Paytm doing? They obviously are the leaders in payments, right? Because they were way ahead. And I think they've built a phenomenal technology platform. So when you navigate through Paytm, you know that Paytm has almost become like a Colgate of payments, right? So, so I think that in that sense, they built a phenomenal payments business, but unfortunately, payments doesn't make money. So now what they're doing is that they are getting into the lending business, where to the same payment customers, a small fraction of that payment customers, they will make short-term loans through a postpaid, wallet, right? So they might tell you that, okay, Ankit, because they know the kind of transactions that you are doing through their payment platforms. You are paying your bills, so they know the level of credit and they have a lot of data. So on the basis of the data and the algorithms, they can tell you that, okay, I'm giving you 20,000 rupees credit, which you can use. And if you over 2 or 3 cycles repay that and are disciplined, they will increase that to 60,000 or 50,000, right? So I think that a company like Paytm, what they did, so many of the new age businesses, they get into things which are loss making just to acquire customers. But then they have to find a way that after I've acquired this customer, how can I monetize this customer to sell him something else which makes me money, right? And therefore, I think that as individual investors, you will have to think about a lot of these things before you invest in the company, whether you have the technical abilities to understand whether Nykaa is the one that I should invest in, or whether Paytm is the one should I invest, or Policy Bazaar is the one that I should invest. I think it's not that easy. You need a history of how some of these businesses have evolved globally. Then you have to contextualize these businesses in the Indian context, because sometimes India can be very different, a very difficult industry to crack. So one way to do it is that either you allocate a very small amount of money, keep a very long-term view, and create a basket of opportunities rather than investing in any one company, right? Or you let a professional do it, right? I'm sure that there will be, in some time to come, there will be funds which will be available, which will solely focus on investing in new age companies, right? Maybe start with a small investment there, And there is a huge learning curve that will be evolved, which will be involved in investing in these companies. I have no doubt that 10 years down the line, these companies will form a large part of the market cap in this country. But the journey is not going to be smooth. As we've all realized, like many of these companies have corrected. I mean, Paytm stock price has corrected from 2150 to almost $500. That's a huge, correction. So you have to be very careful. It requires a lot of understanding of what is happening in the environment. It's not that easy. So either you have a basket approach, or you give it to a professional to manage who understands how to evaluate these companies.
But as you rightly pointed out, the path to profitability is important. But we see that there are multiple other new age companies which are planning to list as well. Take the example of Delivery, which is launching its IPO soon. We have Farm Easy, which is lined up. We have Oyo, which is lined up. So do you believe that there would be consolidation in this space, and the likes of Tata's or Ambani's would consolidate and launch the apps like Tata New? Or will they have a standalone platform which can grow?
See, I think you must understand that whenever there is a disruption in any industry, right, 2 or 3 things happen. One is that it gives an opportunity for completely new players who have no history in that industry to come and take away some market share. We discussed Tesla, right? Where was Tesla 10 years ago? But you have Toyotas and the Hondas and the BMWs and the GMs and the Fords of the world, which have been around for 4, 5, maybe some companies have been around 100 years. So whenever there is a new disruption that happens, there will be a couple of new players which will come in. Now, maybe 5, 10 new players try to take a shot at it. Maybe 1 or 2 will succeed. But they also force the existing players to reform. So today, if you look at it, whether it is a Ford or a GM or a BMW or a Volkswagen, everybody is going to have their own offerings of electric vehicles. It's not that they're going to sit on their backsides, right? So take the example in India, okay? Electric two-wheelers, okay? Now, who are the traditional players in EV? Bajaj. In two-wheelers, Bajaj, TVS, Hero, right? Now, who became the largest player suddenly from nowhere? Ola. Came from absolutely nowhere and dived into the scene, had the largest factory. But look at what is happening right now, right? I think there are huge complaints in terms of service. There are fires that are happening, right? Now, many of these new players, they do not have the experience. See, this is not a service business. You're not starting a business on the internet. This is a physical business. You have to deliver a product. The product has to be serviced. There has to be reliability, right? So you can be the first and the fastest, but whether you will remain the first and the largest player 5 years down the line, I do not know. I mean, if Ola goes the way it is going, it may be very difficult. And some of the existing players who are experienced in understanding how to deliver a great, reliable product may be slow. So it's sometimes it is a matter of the hare and the tortoise. Do you want to be the hare or do you want to be the tortoise? Right? I remember this very clearly when retail was a hot industry, just like we are talking about the new age businesses today, right? And my office was in Navsari building, and the Trent office was there. So while going up and down, I used to talk to the CFO, and at that time, Biani was the new young poster boy of retail, right? So they started Big Bazaar and they came from nowhere, right? And they became so big. Now, 15 years down the line, where are they? And where is Trent? Right? And Trent the guy used to joke and tell me, look, we are happy to be a tortoise. We will learn, We will grow slowly. We will learn. We will perfect the model, learn, perfect the model, learn, perfect the model, right? So it took them 15 years to perfect West Side, but it took them 5 years to grow Zudio, right? And they tied up with Zara to understand how international fast fashion retailing is. They were a tortoise, but it was a sustainable game. And look where the Future Group has landed itself into. So, the thing about these new age industries is that, yes, whenever there is a disruption, there will always be an opportunity for one or two new guys to come in and take away a large part of the market share. But then it also forces the existing incumbents to reform and adapt and fight back, right? So, I think Baba Ramdev is a great disruptor in the FMCG industry, right? He came on the promise of Indian culture-based healthcare products and medicines based on Ayurveda and yoga, and everything. And initially, people, dismissed him. ठीक है, yoga guru है, क्या करेगा, right? Then what happened? It forced every single FMCG company was scrambling to build Ayurvedic products. Right? Hindustan Lever went and bought Indu Lekha. Colgate launched Colgate Ved Shakti to compete with the Patanjali toothpaste. Right? So this is what happens. Every few years, there is a disruptor who comes in. And you don't have to be a very high-tech guy. I think Baba Ramdev is a disruptor. He came, he shook up everybody. And he came up with a absolutely new thesis, right, of making our India culture-based, health-based products. And then all the MNCs were scrambling, trying to follow.
What you rightly pointed out on this new age technology and the tech platforms being disrupted, there's an impact on the traditional banks as well. So while technology has disrupted the traditional banking space, we've seen the managements of the blue-white twin stocks of the markets made the elephants dance, but the markets don't seem to enjoy the performance and are raising concerns over the ROA and ROE, which will be impacted for the next few quarters. And they also have doubts on the 20% growth rate, which they have been consistently maintaining. So how should one play the banking sector?
Yeah, so it's a very interesting question you asked, Ankit, right? I mean, the banking sector has grown, as I showed in my chart, right? It went from 12% of Nifty to 40%, almost 37% of Nifty, right? But I think the financial services industry and the banking industry is going through a massive technological disruption, right? On the liability side, which is on the deposit side, they still have the strength because the fintechs are not allowed to go and raise low cost deposits. See, in any banking business, right? What is your raw material is money. Your raw material is low cost deposits. And then you use that low cost deposits to lend on the asset side. So whether you do unsecured lending or home lending or whatever, right? Now, what is happening currently is that while the liability side advantage still remains with the traditional banks, see, if you have a couple of lakhs of rupees, you're not going to keep your money with a Paytm bank. You will keep it with HDFC or SBI or ICICI or any of the companies where you trust the brand. That's where you'll keep your savings. But on the asset side is where the disruption is happening, right? So now many of these companies are giving you BNPL or, for example, Bajaj Finance came and disrupted the lending business, even though traditional banks like HDFC and ICICI and Kotak were around. How did they disrupt? They came and started giving you 0% EMI if you went and purchased any consumer durable or whatever, right? So I think that what is happening in the financial services industry is that there is massive technological disruption that is happening. And that is why I showed that chart, that why is it that traditional blue chip lenders like Kotak and HDFC Bank stock price struggling, and why ICICI Bank and Bajaj Finance stock price has done better than those two, is because their digital capabilities are far better than the others. So when you start evaluating financial services companies, you have to not only traditionally look at what is the ROA, what is the CASA, how much low cost deposits they have, but you have to also look at their digital capabilities, right? Are you able to acquire customers digitally? Are you able to have that journey which is seamless? Because today's young people don't want to talk to a bank representative. They don't want to go to a branch. Everything that they want to do is on this. So if you can't fulfill his or her need as a banker seamlessly, right, then you will lose customers. Maybe some of the still traditional customers are okay because they are so habituated to doing work in the way they do. But the new customers are, are all like, for example, my son has never been to a bank branch ever. He's only learned doing banking on the phone or on the internet. So if it's going to be very painful journey for him to transact on a bank where the journey is not seamless, then, he's going to, that bank is going to lose him as a customer. And some of these new age companies are giving you solutions which are so seamless. But I think in banking, in my view, what's going to happen, because it's a regulated business by RBI, right? I think that there will be more collaboration between the new age and the traditional banks. What is happening is that the new age fintech companies are very good at customer acquisition, and but they will use the balance sheet of the banks to lend because they don't have access to low cost deposits, right? So today, for example, when a Paytm gives out loans, right, they use Aditya Birla Finance at the back end. They use their balance sheet, or they will use HDFC Bank as the balance sheet, right? But what happens is that the value of a enterprise is if you own the customer, right? So over time, if you can't acquire customers digitally, and if you are only lending your balance sheet, then over time your P's or your price to book will derate. And the guy who owns the customer, who acquires the customer, his value will go up, right? So it's going to be a little bit complex in my view in the financial services business. Already the market is telling you that they are re-rating banks and NBFCs which are digitally more savvy, and derating banks which are digitally still behind the curve and just playing catch up. But in a few years, I think that you will see a very different animal, right? You will see a cross between a zebra and a horse, something like that.
We are short of time, Hiren bhai. So as it's a Sunday and lunchtime is inching closer, we are very hungry, not only for the traditional amras puri, but also for the top sectors which can act as appetizers to their portfolio. So before we conclude the session, if you can give your insights on top 3 sectors which you would bet on based on your investing mantra for the next decade.
Wow. Well, I think that if you look at the big areas where money is going to be made, right? I think, as I explained to you, that as our per capita increases beyond $2,000 and Indians get richer, they are going to spend on discretionary goods, right? So let's say everything that is part of consumer discretionary, right? So let's say fast food, right? because there is more trend of people eating out today than eating at home, right? And that trend is only going to accelerate. Or, for example, electric vehicles, EVs, some players who are profitable and who are ahead of the curve. At least one of the companies in India is Tata Motors, who's ahead of the curve, when it comes to electric four-wheelers. So I think transportation, green transportation. So people who are leaders in electric vehicles, which is, again, I would put it under the consumption basket, right? So I think consumption will be a huge play in India because Indians are going to get richer and they are going to buy more and more premium products. They are going to eat out. They are going to travel and do holidays. So try and pick companies which which are linked to consumption, not necessarily daily items of consumption, but more about as they get richer, what do they spend on, right? So what is roughly called discretionary consumption, which includes automobiles and big houses and so on and so forth, right? Housing can be a very big trigger over the next few years. Second, I think that over the next 10 years, manufacturing is going to make a big comeback in India with the PLI schemes and, with geopolitical realignments around the world. People don't want to put all their baskets, all their eggs in one basket, right? So I think there is huge diversification that is going to happen away from China. And there are several ways to play that, API companies, specialty chemicals. There will be a few global leaders like this from India. Just like generic pharma became very big in the last 20 years, the Suns and the Ciplas of the world, they became very big because, they became large exporters of generic medicines. But I think that time is over now because generics, there's a lot of price competition. But I think API companies, good quality API companies, which make raw materials that go into pharmaceuticals or specialty chemical companies, the manufacturing, all electronic manufacturing, semiconductors, we're starting to make, people don't know, but we now export more smartphones than we import, right? So manufacturing, great companies in manufacturing in these areas would be another bet that I would take, right? And the third is that what I would call as the new age platform or technology companies, whether they are in financial services or whether they are in retailing or whether they are in banking, right? You'll have to pick and choose. It's an evolving area. As I said, be very careful when you invest. But I think, as I showed, that leadership and market cap changes substantially over time. So if you're looking at the next 10 years, you will need to have some of these companies into your basket of investing. But either you take a basket approach yourself or take help of a professional to do that. But you will have to move away from traditional blue chips to how industries, every sector is going through a disruption. You'll have to find which are the companies which are adapting better to that disruption and invest in them, right? So I think that's where I would put my investing, across new age technology companies, consumer discretionary plays, and a few manufacturing plays where India can be a global leader. Because I think the time has come. And, people don't realize it, but just imagine if India did not have, we as a country did not have the capability to manufacture and develop our own vaccines, this country would have been in big trouble. Just imagine trying to vaccinate 1.3 billion people using imported vaccines. One is obviously the cost, but it wouldn't have been available because every country would have first used the vaccines for their own. We are amongst the 4 countries in the world which had the ability to develop our own vaccines. A lot of the so-called Southeast Asian tigers had to rely on Chinese vaccine. The entire Middle East was on Chinese vaccines or American vaccines. So US had 2 vaccines, right? UK had 1, but one of them was in collaboration with Serum Institute, which is the AstraZeneca vaccine, right? Russia had 1 and China had 1. Tell me one other country which had the capability to develop their own vaccines. India was one of them. And that tells you that about India's scientific power and manufacturing capabilities, right? So I think believe in us. Times are changing. India is changing. And, choose whatever sector, whether the sectors I said or whatever, but invest in India. I think the next 10, 15 years are going to be phenomenal.
Thanks, Hiren bhai, for this enriching session, and I'm sure the viewers have a lot of insights to take away from this, and hope to interact with you more often. So, thank you for your time on the platform. And before we conclude, final words from your side, and then I'd like to pass on the play to Drshtikon team as they have a message to convey to our viewers.
Sure. I think it was great. I hope I was able to illuminate. As I said, this is a subject which can go on for hours and hours, and sometimes an hour and a half can seem very less. But, if any of you have any questions, you can send them across to me. I'll try my best to answer them. And again, it was a great privilege to be on this platform. And I had a good time.
Thank you.
Thank you, Hiren bhai, for such a wonderful session. You had us all sold on the India story. Probably 10 years back, the mantra was "Apna time aayega," but I think now you have us all believe that "Apna time aa gaya hai."
Absolutely.
We're waiting to see how the next 5 or 10 years pan across for us from now. And I'm hoping maybe 10 years back, we'll still be sitting here talking on how great the past decade was in terms of the returns that we made, or in terms of the stock market play that has happened, or the kind of alpha we've been able to generate over the years. But thank you so much for the session. So insightful. You made stock markets seem like very, how do I put it? Quite easy, very easy to interpret, though I'm sure it's, of course, not. And as they say, the only thing constant in the world is change. And I think that's what the stock markets, or the scripts that are on the rise today would be facing. So probably we'll stay glued to more of your thoughts and the markets to see how they've gone. But excellent session, Hiren bhai. Thank you so much for coming on board today. And thank you, Ankit, especially when dealing with people like Hiren bhai. It's always right to know it's always important to know what are the right questions to ask. Because apart from what things are said, there are a lot of things important which are still unsaid. So thanks for probing onto that also, and making this session interesting for all the people who have come here. Meanwhile, I have a message for all the viewers who have come here today. Drshtikon has been on air with live webinars for the last 2 years. And this is the time where we end season 1, and we would be taking a short break. We will, of course, be interacting with all of you on YouTube, or through some curated content, and through emailers till such time that we come back. But I think this is the apt time for us to give you a very small insight to what went on behind the screens behind the screen in Drshtikon. Most of the content, most of the speakers that you've been seeing on air have been coordinated by Rajan. So Rajan is a very shy guy, doesn't come on very easily onto the screen. You sometimes have to force him and arm twist him to come on the screen. But well, this is what he does best: interacting with speakers and keeping the conversation alive with the speaker identification. So yeah, Rajan, maybe you would like to say something.
Yeah, Prashant. Thank you, Prashant. Rightly said by Prashant, as our aim was to start a common platform for Bhatia community, where Bhatia personalities can share their views with their respected fields, which will be helpful to everyone, not only Bhatias. As we have seen that so many people are coming on this platform. So that was the best thing what we have able to do that. And we have tried our best. and we will come in the second season also. આપણા ગુજરાતીમાં જેમ આપણે કહીએ છીએ ને કે આપણી ભાટિયા કોમ્યુનિટી બહુ નાની છે, પણ આપણા ભાટિયાઓની અચીવમેન્ટ બહુ મોટી છે. So now I will say કે we are proud to be a ભાટિયા, no doubt about it. જેમ હિરેનભાઈએ કીધું કે એમના દાદાના જમાનાથી એમને ઇન્વેસ્ટમેન્ટ કરતા ગયા અને આજે એમનો પૌત્ર આજે ક્યાંથી ક્યાં પહોંચી ગયો. That is the achievement. That is the biggest achievement what Hirenbhai has done. અને આ જે દ્રષ્ટિકોણનું પ્લેટફોર્મમાં અમને જે ટેકનિકલી હેલ્પફુલ થાય છે એ છે અમારા ધવલ ભાટિયા. ધવલ ભાટિયા જે તમે જેટલા બધા ક્રિએટિવ, એમનું મેઇન કામ ક્રિએટિવિટી છે. જે તમે બેનર જુઓ છો, આજથી લગભગ 36, ટુડે ઇઝ ધ 36th વેબિનાર, જેટલા વેબિનાર એમને તૈયાર કર્યા છે. અને જ્યારે આપણો દ્રષ્ટિકોણનો પ્રોગ્રામ ચાલુ થાય છે, એનું બેકગ્રાઉન્ડ મ્યુઝિક, સ્પીકર સાથે તથા ઇન્ટ્રોડ્યુસર સાથેની એમની લાઇટ, સાઉન્ડ, એવરીથિંગ ઇઝ મેનેજ્ડ. સો હી ઇઝ અ ગ્રેટ ગાય. યા ધવલ ભાટિયા, પ્લીઝ.
Thank you, Rajan bhai, for the kind words. I was always inclined towards creativity, and because of this core group and initiative of Drshtikon, I got an opportunity to wear my creative hat. I would like to thank all the audience for being a part of this journey. It has been a wonderful experience from designing the logo, designing the banners for the presentation, for the WhatsApp, for Instagram, and having a creative yet simple collateral for the session. This was the good learning in season 1. And as Rajan bhai mentioned, we'll come up with something different in the season 2. But I would like to also thank the core team and mention Sheetal about her initiative of keeping the database for all the speakers, aligning with the introducers, which was a good job. And the sessions wouldn't have been possible in a smooth manner without her efforts. Over to you, Sheetal.
Thank you, Dhaval. It was a great experience interacting with all the young members and who appeared on the forum to introduce and compare. As we say in Gujarati, "Orkhan jevi koi khan nathi." So that we have done. We have met so many people on this forum, and we have really our speakers database and like how we literally interacted with everyone. We really enjoyed this session. Our speakers database was also very diverse in spanning many fields of work, including yoga, stock market, mountaineering, dance, and whatnot. I'm a teacher at my professional space, but Drshtikon's experience made me a learner, and I loved it. Helping me in my task and also in moderating some of the webinars was my partner in crime, Darshni. Darshni was a former banker. Over to you, Darshni.
Thank you, Sheetal. I must say, Sheetal and me really enjoyed interacting with the youngsters, trying to guide them, also, help them with soft skills and meet so many of them and get them to the forum to introduce our wonderful speakers. Of course, we were maintaining the database together, plus helping our youngsters to introduce. I must say that I enjoyed moderating some sessions. It was a learning experience, of course, because going live, talking to people on on the Zoom platform was something new for me. On the stage is totally different, and Zoom is totally different. So it taught us so many things. And of course, Drshtikon has done the 36th. Today is the 36th session, and we've got so many speakers, more than about around 45 speakers we've had till date. And interacting with different people, different varied fields was an experience in itself. We've covered speakers from, education, from food industry, from, dietitian, nutrition, and finance, banking, various sectors we have covered. And I'm sure we'll come up with something again. And not to forget mentioning, I would have got more opportunity to be a moderator if Prashant would not steal the show. And so to talk about Prashant, he's done most of the moderations. He's done a wonderful job. He's been the guiding force. All of us have also seen him handle the session so smoothly. I think we must appreciate each and everyone's effort here. Thanking all our viewers and our speakers. I ask Prashant to take the screen. Over to you,
Thank you,
Prashant.
Darshni. Other than all the people present here today on screen, it would be right to mention also our mentor, Sanjay Bhai Jasrani, who's been the guiding force and who's always been the go-to man in any kind of query or guidance that we've had. Other than the people that we've just spoken about, numerous people have helped us in promoting this forum, in reaching out to speakers, referring speakers. People have come as introducers on this forum. People have helped in terms of suggestions, feedback, criticism. So I thank all of them from the bottom of my heart, and it's been a great learning experience. It's been a great interacting experience, and it's wonderful to know the kind of people who we have in our community, other than experts, other than people who have done very well on the international, national front, on the business front, also people who have helped out in a very constructive manner. So a big thanks to all of them. And let me, Drshtikon takes a pause here today. So the final word today here, again, thanking Hiren Bhai for the wonderful session here. Also congratulating him on the 20 years for Alchemy Capital. I'm sure the name might have helped him strike the right chemistry with the stock markets. So thank you so much, Hiren Bhai. We will look forward to the interaction, more interaction with you in future. And for all the people who ask questions on this forum but haven't got the answers today, we will get these answers by mail from Hiren Bhai and pass them on to you. So thank you so much. Have a wonderful day, all of you. Thank you, Hiren Bhai.
Bye-bye.